we're going to be talking about what is PMI and how do you get rid of it.
PMI is private mortgage insurance. FHA and government loans, it's called MIP, mortgage insurance premium. It's a premium that the buyer is buying, but it's an insurance policy for the bank. So that way, if there's ever a foreclosure or they have to take the house back, or there's a short sale or something, that insurance premium is to make sure that the bank gets their money back no matter what. One of the frequent things frequent conversations that I'm having, most popular one is let's say someone purchased a home with an FHA mortgage. Usually it could be a multifamily. They want to owner occupy one of the units, want to do an FHA loan. It's because it's a low down payment. You only have to put 3.5% down. They get a great rate with it. But one of the bummer parts about the FHA loan is that mortgage insurance is on there for life. So the only way you can get rid of the PMI for an FHA loan and get into a no PMI loan is to refinance. And you'd have to wait until you had a certain amount of equity to get rid of that mortgage insurance to be able to get into the new loan.
Do you have to be at 21% at that point to get out?
For single family homes, you have to be at 20% equity for them to be able to get rid of the PMI. For multifamily loans, you have to be for a two family, you could be at 15% equity to have really reduced PMI, 20% to get rid of PMI, and then 25% for three families and four families. So it can get kind of confusing. That's why you want to talk it out with a lender and really know the next game plan. If you buy a three family with an FHA loan, what does my house need to be valued at? And what do I need to pay my loan down to get rid of this mortgage insurance? FHA mortgage insurance is not always cheap. $400,000, $500,000, $600,000 multifamily these days, the PMI is at $200, $300, $400 a month, depending on the loan amount. So it's a big part of the payment, and it can make or break a dramatic difference when you do the refinance. It's a short-term strategy and a long-term strategy. Talk about how to get into the house, how to become the owner, how to put a low down payment down, but then talk about the future. What's the next step to be able to make this situation better? And that's a strategic refinance to get rid of the PMI. Let's say you're buying a single family home, you have 800 FICO score, you have 5% down, you do conventional financing. The mortgage insurance is going to be on there because you're still putting less than 20% down. But with conventional loans, once you pay the principal balance down to so that you have 20% equity, the PMI can come off without having to refinance, which is one of the benefits of doing a conventional loan, is that in the future, you will have a reduction in your payment because this PMI is going to go away.